Steve Blumenthal, you are not a fan of the traditional 60-40 stock-bond split. Tell me why not.
Well, you've got a market today that's overvalued by about 20%. PE measures, if you take a look at a median PE, kind of takes out the high PEs, takes out the low, and looks at the bulk on the S&P, the bulk in the middle. The 50-year average is a little bit better than 16. So let's call that as a fair value level. Today we're about 21. So we are in the overbought camp, overvalued camp. Forward projected returns for equities are smaller than what we've experienced. So expecting what happened last year I don't think is realistic. The other piece is you've got fixed income at the lowest level, near lowest levels that they've been in history. So we're not quite down there, they can go lower, but how much potential return is going to be fed to that 40% of the portfolio that's invested in bonds? The risk is actually inverse and significantly bigger. So I propose looking at expanding the portfolios to include what endowments and foundations have done for years, add to this tactical space different strategies that aren't dependent on.
So you have a three-bucket solution, 33% stocks, 33% bonds, and 33% in a tactical trading account. What are you doing in that tactical trading account right now?
So this month, one of our strategies is long the S&P, SPY, long TLT. It looks at real estate, it looks at commodities, so Vanguard VNQ, the Vanguard REIT, DBC, commodity. It looks at cash, BIL for treasury bills, and it runs a relative strength analysis of these 5 things against each other over the last 30 days to say which ones are exhibiting the most relative strength. We've been largely equities last year, very little exposure to fixed income. This position this month going into February, 50% TLT, which is the 20-year bond plus treasury exposure, and 50% SPY. So we're seeing a little bit of shift towards bonds.
And with regard to currencies, you also short the yen, you use an ETF to do it. This is a very crowded trade. Why are you jumping in?
Well, I still think that when you look at the global currency creation machines that are alive and well, Japan is really entering into the race in a very aggressive way. So, and their problem as far as debt is significantly bigger than most every player on the planet. So this devaluation, this creating of all this currency, their debt problem, their aging population, I think that's still, their way out is to devalue their currency. That's their objective and goal, and I think that they're going to win at that goal.
And that's why it's in that third trading bucket. Thanks a lot, Steve.
Thanks, Greg. Good to see you.
Thank you for watching The Street.